Good morning. Today is Thursday, July 2nd, 2026. I'm Joe Terril, president of Terril & Company, private wealth managers located in St. Louis, Missouri. This is another update for our clients and also our people who follow us on our thoughts on the markets and the economy, inflation, interest rates, etc. Let me first apologize for the casual appearance with the brutal hot weather and humidity that happened in St. Louis. I just decided to dress down and comfortably. With that said, let me start right in. The hot weather actually overall is a slight positive for the economy. But let me turn to Kristen and ask Kristen, we've been talking and following economic reports since the last video and intensely. Tell the viewers what's going on with the economy.
I think we still agree that the economy is strong. Job numbers were reported today and they're reasonably good. So people are definitely still out there spending money. Actually, the auto sales were very strong. So, I don't think anybody's canceling their 4th of July plans. People are still going on vacation this weekend, out spending money, as you can see in the stores, and yep, people are still spending.
Joe, she's starting to sound like a broken record.
I know. It's every time the economy looks good, you look at the news and maybe you think, oh, AI is taking everybody's jobs, but it's not what we see in the numbers.
Yeah, the talking about being a broken record, it sort of is, but we do want to get across, we still believe the economy will stay strong. And this relates to interest rates. Dave Carter, who is our senior bond portfolio manager, is on vacation. So I'll pick up his part of it by stating we continue to believe interest rates will move higher, not lower. The first Fed meeting for the new Fed governor didn't really pound the table on that, but it certainly seemed like the thoughts of a year ago that rates were going to be cut 3 or 4 more times, that's all over with. If anything, there'll be some rate increases on the short end. But today, with the jobs figure, was very interesting because yields on a 10-year U.S. Treasury actually moved up a tick or two, and we're back up knocking on the door of 4.5%. We believe that you have to look past the United States economy and look at what's going on around the world. Interest rates in England, Germany, Japan on longer-term investments continue to go up. And if we're going to compete for capital around the world that we need to do in order to finance our budget deficit, as well as corporations trying to borrow literally hundreds of billions, we're going to have to pay a higher interest rate. And our bond portfolios are structured accordingly, and all year long that's paid off for us. In the last quarter that just ended June 30th, we had positive results from our bond portfolio where most fixed income portfolios were lower. So like a broken record, we continue to believe rates will go higher. But let's turn for a moment to Bill and Russ. I'd like for them to talk a little bit about stocks and what's going on there and just how narrow the breadth of this rally we've seen in the last quarter actually is, and what it looks like behind the scenes. But Russ, this is your specialty because as your notebook shows you there, you track a lot of this. Explain to viewers what we're talking about.
Sure. Thank you, Joe. So First of all, I would say in terms of stocks in the second quarter, stocks had a reasonably good second quarter. But that does follow on to a first quarter that wasn't so positive or reasonable. I think there's one key element to both the first and second quarter, and that's volatility. And I think that volatility is alive and well, both to the upside and the downside. And I think it's going to be with us for a while. The other piece of it, if you really kind of get under the hood, as you're talking about, in terms of what really is driving the stock market, especially in the second quarter, and it's really been artificial intelligence stocks, or what I would call second derivative ancillary sectors related to artificial intelligence. And what do I mean? Technology stocks, especially in the kind of semiconductor, semi-capital equipment space, are doing very well. And it's kind of ironic, at the same time, you and I were talking about this yesterday, software stocks have not done quite as well. The almighty Microsoft hasn't had such a great year. So there is some bifurcation in the technology sector, but if you're a semiconductor stock tied to artificial intelligence, you've had a pretty good second quarter, actually an exceptional second quarter. Kind of secondarily, who else benefits from that? Energy-related names, and that's one positive for us, Joe, right? We own some of the energy
Sure.
infrastructure names, the MLPs, which provide our clients really good dividends, and so we've benefited in that area. And then some of the industrial type names as well have been a beneficiary as we talk about the dollars rolling out from capital expenditures into data centers. So when you look across the board, and if you look at the S&P subsectors year to date, it's technology or technology related sectors that are outperforming. You don't see healthcare doing very well. We've owned Citigroup in the financial space, and Citigroup has been an outperformer. Financials in general have not done very well versus the regular index.
Russ, thanks. I'm going to say this as I turn to Bill, and Bill, you correct me if you think I'm misstating this, but the fear that we have about trying to chase this high technology AI trade is the volatility. Qualcomm is a good company and a stock we own, and the stock was 150. A month later, it's 230. This morning, it's 170. You're seeing these type of moves. So, yes, if you want with the averages to duplicate that, you're going to have to buy a small amount of high-tech stocks and keep your fingers crossed that there's no bad news on them, because when it happens, it's what I call, they take them out back in the alley and shoot them in the head. And there's not enough equity money to go around.
Yeah.
And we see this volatility as they rotate from one sector of the high technology to the other. But the majority of the move in the averages is just from a handful of stocks.
Yeah.
When you look past those, reasonable returns, but nothing like what those averages are saying. So what say you, Bill?
Yeah, so thanks, Joe, and I would agree, and to further add to Russ's comments as well, Russ mentioned the volatility. Joe, you've mentioned basically what are essentially trade flows going from name to name, and you get exaggerated moves in specific stocks.
On a daily basis.
On a daily basis, extraordinary moves, 1 year moves in a day. Joe mentioned the volatility, the valuations are very high, and he mentioned the concentrations. To just add a little color to Joe's comments, the top 10 stocks in the S&P, 10 of 500 stocks, generate 34% of the earnings. That's an extraordinary amount of impact. Top 10 stocks are 38% of the market cap. So When you own the S&P 500, you think you're completely diversified, but really you're weighted towards 10 names, right? And they are heavily weighted towards technology, AI infrastructure. So it's helpful to take a step back and realize what you own and be purposeful in the assets you own.
Let me say it another way, because I think it's important for our clients to know what we believe about this. This is not normal, what you see going on. Not with Thomas and Kristen, but just between us three. I hate to say it, but we got about 80 years worth of investment experience. And Russ, you said it the other day in the little missive that we send out with our performance reports about why we're staying defensive. Cite some of those figures about margin debt and et cetera, if you will.
Well, I think one, at Terril and Company, Joe, you've done a good job over the years on this, protecting client capital. And to Bill's point, or Joe, you brought up a great example on the Qualcomm. The daily volatility in individual names is something Bill, Joe, myself haven't seen in a long time. You know, you talk about on the fixed income side, higher interest rates. We talk about, you know, retail FOMO. FOMO is the acronym for fear of missing out, right?
Well, how about them just completely ignoring the trouble in the Middle East, just like, that doesn't exist, don't worry about that.
They are absolutely looking through that, and I think one thing we're watching very carefully, we're talking about interest rates, is inflation. And you know, what will be happening with inflation with the Fed. But you talk about margin debt, the margin debt's the highest it's ever been. So
the indication of how much of this market's being driven by speculation, whether it's people leveraging on the margin debt, whether it's hedge funds that are going all out trying to use computer programs to chase momentum.
Zero day options.
All these things lead somebody with a little more experience to believe maybe this market's getting near a top, and that's a darn good reason for us to be very cautious about where our clients' money is actually invested. But I want to turn a moment to Thomas, is doing an internship with us here. Thomas, for the last 3 weeks, we've been having you do nothing but earnings research. And it's interesting in that some of the companies that are down in price, Walmart is a nice example, down from 135 by 20, points or more. As they chase the craziness of the high tech, these companies, Thomas, that we asked you to be looking into, earnings are okay. True?
That's 100% true. We're seeing stocks just Walmart, Coca-Cola, people who aren't really hit by the wave of AI and don't directly benefit from it. Although, I've been running valuation models on them. Corporate earnings are strong, capital markets are hot, and there's no structural reason for any of this to reverse, but their prices on their stock prices are not seen as big of a lift as the more tech-centered ones are, despite their earnings being just as strong, if not stronger than the rest.
So we'll be back with another video soon, but we just wanted to update as we start out into the third quarter of the year. So with that said, let me stop a second to wish everybody a joyous and safe 4th of July. Thank you.
Thank you.